If you are a first-time homebuyer, this is the first video of mine you should watch. The first two questions I typically receive are, what is my interest rate and what is my maximum loan amount? Interest rates are generally determined by only two factors, your credit score and your down payment. The higher your score and down payment, the lower your interest rate. And if you qualify for a first-time homebuyer program, your rate will be even a bit lower. Some of my clients believe that higher income and savings can result in a lower interest rate. This is typically not true. Now, let's shift gears and discuss how we calculate your maximum loan amount, which is different than how we determine your interest rate. We determine your maximum loan amount by calculating your debt to income ratio. We divide the sum of your monthly debt payments, which includes your projected mortgage payment, by your gross monthly income. It cannot exceed a fixed number, typically 45 to 55%, which caps what you can borrow because your projected mortgage payment is included in your debt. If you have a much higher than average credit score and/or significant savings, you might be allowed to have a somewhat higher debt to income ratio and therefore qualify for a modestly higher loan amount than you otherwise would. And one last note, everything I just discussed are rules of thumb for conventional mortgages. However, these rules can be somewhat different for other government-backed loans, including FHA, VA, and USDA, which are not geared for everyone. And there are also specialty mortgages for borrowers in unique situations who have trouble qualifying for conventional mortgages. These are called portfolio loans because they are not guaranteed or insured by the US government. They are mostly offered by local banks and have higher interest rates. My rules of thumb will help with portfolio mortgage products, but other factors will also apply. Now, a little bit of history. These rules of thumb likely sound like common sense. However, if we go back 20 years, qualifying was very different. Income amounts were often not confirmed with documents like pay stubs and W-2s, and there were mortgage programs where you didn't have to report any income at all. You could leave your income blank on the loan application. These programs were initially designed for very specific, uncommon situations and for borrowers with excellent credit and savings. However, these programs were abused, guidelines were relaxed, and many borrowers were qualified for loans they couldn't repay. This is why the so-called mortgage meltdown happened in 2008. The underwriting guidelines we have today emerged during the years following 2008. I hope you found this helpful. For more about calculating your maximum loan amount, please watch my video called Your Pre-Approval Amount is a Moving Target. See you again soon.